morning, ladies and gents. Good morning. Such a pleasure to be here again, and nice to see some people sitting in the front row. I have to say, in Fintuk yesterday, nobody sat in the front row, so I'm not sure. Clearly, we're less scary to Joe Burgers. We've been turning to economics. We've been in this acute tightening cycle. We've got 50 years here of interest rate tightening, shown by the proportion of emerging market central banks in yellow and the proportion of advanced economy central banks in blue that are tightening at any one particular point in time. So, outside of, the kind of late 1980s, then, in advanced economies, we haven't seen a tightening cycle as rapid and as pervasive as this. And in emerging markets, really, we've never seen anything quite like this in the last 50 years, even in the emerging market kind of crisis, in the late 90s and then into the global financial crisis. So, what's been happening? Well, if we look at the US, then we can see here inflation, the blue shaded area, and US Federal Reserve rates. This huge inflation shock, where the initial narrative was that this was temporary and that it was a supply bottleneck issue coming from the COVID lockdown and reopening. And that narrative has clearly proved to be incorrect. Now, the US Federal Reserve took the best part of 18 months plus to get hiking rates. And so they were late to this party. A lot of emerging markets didn't have that luxury. And if we look at Brazil as a good example, you can see the same framework for Brazil, Brazilian inflation, Brazilian rates. Almost as soon as inflation started picking up, they started hiking rates. They said, we have seen this story before, we cannot sit back. They hiked rates, the US Federal Reserve's hiked rates 5%, Brazil hiked rates double that. And I think one of this is important, I'll come back to it when we come to positioning, because one of the opportunities that presents here is, I think, because a number of emerging markets started earlier, they're also plausibly going to be in a position to start cutting earlier and quicker. And I think that can offer opportunities for those equity markets which really suffered as risk premium expanded and as the US dollar did very well in the last 2 years. This hasn't just been about either inflation in the form of food and oil and fuel. It has been much broader based than that. So if we look at the proportion of inflation baskets in emerging markets here in blue and advanced economies in aggregate in the yellow, with the standard deviation ranges around that, this is the proportion of the inflation, but the total inflation basket that's going up by more than 5%. You can see in emerging markets, that is more than 70% of the basket. And in advanced economies, more than 60%. So this is a broad-based inflation problem. And that is what is causing central banks kind of sleepless nights. That is their part of reaching out for the precarious holds that they want to grasp, up their own El Capitan. On the supply bottleneck story, there is positive news coming through, so we are starting to see some easing of those bottlenecks. Here, I'm looking specifically at the impact of the chip shortage, which I think was one of the particular stories, I think, that we heard a lot about in the post-COVID period. You couldn't get enough computer chips, so the proportion of companies that are citing materials shortages in computer and electronic manufacturing, that's in the blue, and in auto transport manufacturing, that's the yellow. We can see that it's peaked and it's starting to ease, but we're still at an elevated level. So, there is some positive news there, but the flip side, if we look at the economy, is just kind of how hot advanced economy labor markets are. And a way that we like to look at that is to look at, in the US, at the job openings and the job quits ratios. So job openings here in green on the left-hand axis, nearly 10 million current vacancies in the US labor market. So unfilled vacancies, and you can see, whilst it's not at its record high, that it achieved about a year ago, it's still at an extraordinarily elevated level compared to its long-term history. We've got nearly 25 years of history on this chart. And then the other line, the pink line here, is what's known as the quits ratio, which is people voluntarily leaving their jobs. Now, my experience is that people are unlikely to leave their jobs of their own volition if they are concerned about their ability to find another job. If they're concerned about their finances, they're going to stay put and hunker down and try and ride out the storm. So, this is part of, I think, the tension that is being felt inside global central banks, where they're worried about wages because labor markets are tight, but they can see at the same time that some of the economic data is starting to show signs of fatigue. And nowhere do we see that more profoundly than in the sentiment-based indicators. Although in some of the hard data, we are also starting to see cracks emerging. But if we focus on the sentiment just as, I think, a good place to start, then we've got consumer sentiment here in the US on the left-hand axis, and it is, whilst not at its record low, it is very close to its all-time low, which is a really interesting kind of response to a question as to how consumers are feeling when you saw how tight the labor market is. So how do you kind of make sense of that? And I think with difficulty, and hence, again, we come back to this, it is very hard to kind of understand exactly what is going on. Are we in a phase of regime change? Are we just in the continuing throes of the ripples of a kind of post-COVID reopening period? And I would say the jury's out. But there's a genuine risk that we're in a kind of regime change environment. And that could have profound implications for investing. We also see manufacturing confidence here, the pink line on the right-hand scale, not quite as low as it got in the GFC, but at a very weak level. Certainly a level where you can see the blue shaded, vertical shaded areas here are previous recessions. And you can see we're definitely kind of in that recessionary territory in terms of confidence numbers. And hence why it is that the market keeps thinking the US is going to go into recession, and yet the US economy seems to be trundling along just fine. And what's happening there? Well, we don't know. What we do know is that there are some significant long-term headwinds to the macroeconomic story around the world that we as long-term investors, as fiduciaries of client capital, patient capital, with investment time horizons of 20, 30 or more years, where these themes are going to be incredibly important for the returns that get delivered to our clients. And the three that I like to talk about, I'll just focus on one today, but the three I like to talk about are deglobalization, debt, and demographics. And I'm happy to pick up questions later on any of those. But if we just focus on world trade, on the globalization issue, in this slide, we've got world GDP growth as the shaded purple area, and world trade growth as the pink line. And the rather obvious observation is that between 1980 and 2008, world trade, significant growth significantly exceeded world GDP. In other words, it was the locomotive at the front of that world GDP train, dragging it along. And should be no surprise there because China entered the World Trade Organization in the late 1970s, and we saw that whole lifting of Asia and the Asian industrialization story that has been a feature of particularly of the offshoring of manufacturing to those countries in the last 30 years, and the goods price deflation that we've all benefited from over that period. I mean, as an anecdote, and at the risk of running over time even more than I'm going to, I was chatting to my mum. I was in the UK recently, and she was saying that when her parents sold their house, they used the proceeds to buy a TV and a car. And that was all of it. That was all the money that came from the house. So, a television cost about half the price of a house. Now, you can buy a television with like the money I've got in my pocket here. And we've all benefited from that. And now, that feels like it's kind of going into reverse. And I would argue it's going to be even more so than the left-hand slide shows, because if we look at what's happening in the onshoring of manufacturing capability just in the US, looking at US construction spend on manufacturing, So this is the kind of build out of factories and productive capacity onshore in the States. Obviously, we had the US Inflation Reduction Act, we've had the CHIPS Act, which are all aimed at building US domestic capacity. And we can see here over $200 billion now of spend going on, massive acceleration relative to the previous trend in that space. So with all of that uncertainty that I've highlighted, I want to start turning to markets and opportunities. And in that vein, I was pleased to be able to be in our London office, squeeze that in alongside seeing my mum. And I caught up with a number of the portfolio managers who you'll be seeing in clips through these talks. Here we're going to see Alex Arujo. Some of you may have seen him online. He runs our global listed infrastructure fund. And listed infrastructure, I think, is a really interesting asset class in this environment because it focuses on long life assets with growing cash flows. So in an uncertain environment that we're in, then that is an interesting, I think, asset class that we and yourselves for your clients could blend into kind of the offshore allocations, and it is available both on local and global platforms. So let me play for you a clip of my conversation with Alex. So nice to see you again here in London in the M&G offices. Let's kick off by talking about the global economy and in particular the US. Does feel like there may be a loss of macro momentum there. We're seeing some of the high frequency indicators starting to show some signs of weakness. And definitely the market's got a concern with all the interest rate hikes that we've seen that you might, in the next 12 months kind of see a US recession. Typically that wouldn't be great for equities and equity earnings, but obviously you're running the global listed infrastructure fund. And in that there are assets that, have these long cash flows. Can you talk a little bit about, how the kind of investments that you're making in that fund and how you think that they might weather a kind of macro downturn a bit better?
Sure. Well, we invest largely and mainly in assets and businesses that are critical to the functioning of society. During a recession, people don't typically turn off their electricity or their water or their natural gas supply. And at the same time, we invest in social infrastructure businesses that are critical to the functioning of society in the form of, say, hospitals or schools or civic institutional buildings. So in many respects, the cash flows of these businesses reflect the reliance upon the assets by being reliable themselves. And so during a recession, we would expect, and it's been generally speaking the experience, that these kinds of businesses are quite resilient. Not only that, they generate income typically, and that income is designed in our strategy to grow.
Could you talk a little bit more about, because infrastructure is absolutely critical in South Africa. We have obviously a very significant problem with our electricity infrastructure and our transmission grid as well. That's causing issues in not being able to kind of link up to the grid, the renewables that we want to put on stream. I know that's part of the portfolio and some of the investments you look at.
It is, and you're not alone in that issue. Germany is actually on the bleeding edge of this particular issue, especially following the loss of Russian gas, which the country came to become quite reliant upon. Germany is desperately investing in renewable energy, but the grid was configured for a different time, a little bit different from South Africa, but most of the electricity generation was right next to industry. And what has to happen now is infrastructure, particularly transmission lines, need to be built in different configurations in order to connect these renewables. So we have one investment in particular that's oriented towards this solution. In fact, one of the best performing holdings in the fund. And we have it also at the local network, because it's not just long-haul transmission that's required, but it's the resilience of low-voltage networks when you increasingly try to electrify your life, whether it's by way of transportation or heat or cooking. So that's a key aspect for us, as well as, of course, transitioning away from more carbon-intensive forms of electricity generation. And we're doing that around the world. It's a global strategy. Unfortunately, there aren't a lot of investable businesses in South Africa for us to capitalize upon, but the opportunities are, of course, outside and quite widespread in other parts of the world.
Yes, look, hopefully, bankable opportunities will arise in South Africa. So I think there are some milestones we need to cross there. The operational kind of legal separation of Eskom into units may result in some opportunities presenting themselves. So, maybe we'll yet see some of your capital deployed here.
I have a solution. I've actually offered to be an elected official in South Africa if you'll have me, because I've got some great ideas. It's just putting them all in place.
Yeah, well, it'll be interesting to hear those. But maybe as well we can just finish by talking a little bit about climate change, because it's an issue that's hitting, especially the poorest countries feel the most vulnerable. We've had extreme weather. We had floods, in KZN, one of our provinces, last year that were catastrophic, causing hundreds of millions of rands worth of damage. Elsewhere we see wildfires and these extremes, and that climate scientists tell us that's only going to get worse. Your investments are very focused on the long term. So you are in a position to actually make a difference in looking at that multi-decade view. Do you want to just say a few words about that?
Sure. Well, much of the investment portfolio is oriented to addressing climate change by way of renewable deployments, transition fuels. And by the way, the solution that I see as a fantastic intermediate one in South Africa is displacing coal with natural gas. That's probably a conversation for another time. And these very long life assets are consistent in delivering growing cash flow streams because of incentive mechanisms, because of long contracting. But increasingly, because of the kinds of disasters that you describe, whether it's forest fires or floods or droughts or freak storms, we have to be acutely aware of the actual asset risk, because we are buying these assets and owning them. And yes, we manage a listed strategy, so we can move our capital around when required, but we don't want to use that as a crutch. We want to actually examine the sustainability of each of the assets that we invest in the underlying business.
Thanks, Alex. Yeah, I think, lots of opportunities there in infrastructure around the world. I think a really interesting asset class, as Alex has highlighted, with some powerful income compounding properties. So great to catch up with you again. Thanks very much for your insights.
Thank you, David.
Thank you. Yeah, it's worth perhaps adding to that, M&G is working with ACISA and the infrastructure subcommittee there to try and find kind of ways in which I think the kind of listed asset managers here in South Africa can start to support the required infrastructure rollout. But we need kind of bankable projects that are going to come and fit into the kind of mandates that your clients require, with the in some cases availability to the liquidity, which is an issue in some of those long life assets. So I want to turn more broadly now to the question as to overall equity markets, and I can't start that conversation without looking at the US, because the last 15 years, more or less, since the global financial crisis, have been a period of US exceptionalism. The pink line here is the performance of the S&P 500 versus all of the other global equity markets put together. And, over that, I'm going to broadly call it 15-year period, the US has outperformed the rest of the world by about 150% kind of in US dollar terms. And obviously the dollar has done part of that work. So we also have here the US real effective exchange rate, which is a broad-based measure of the value of the US dollar versus other global currencies. And as that is kind of rising on this chart on the right-hand scale, then the US dollar has been strengthening. So it's no coincidence that the US market has been such a strong outperformer against a backdrop of such strong dollar outperformance as well. So the question, of course, is where to from here? And we have seen some initial US dollar weakness coming through more latterly. And as I highlighted, I do think, in my 30-year career in investment, that I've never seen a monetary policy tightening cycle like this one without something breaking at some point. Now, economies are complex systems, and it is very difficult to know as you push on one part of that system exactly what's going to happen to the rest of it. So, or at what point. But I do think that we should be prepared for that. And as I mentioned, I do think in the emerging market space, this different interest rate story that panned out in emerging markets sets a potential backdrop for some of those countries for their economies now to do very well prospectively, over the next 5 or 10 years compared to the US. And that could become a driver of their exchange rates and their equity markets. I think one of the other things to mention in terms of why the US has done so well was just the scale of the fiscal stimulus that came after COVID. So on the right-hand slide here, we've got US nominal GDP. So that's economic growth, including inflation. And the dotted line is like the 50-year trend. And obviously, one would expect that nominal GDP would oscillate kind of around that trend with phases of economic kind of expansion and contraction. But we've had this unprecedented rise in nominal GDP as a result of government stimulus. And that's important because it has driven US equity earnings, and those earnings in turn have driven the US equity market, the S&P 500. We have not seen historically where GDP has moved so far from trend that it has not at some point come back. And we are already starting to see US consumers, for instance, pay down debt. That's not surprising given the consumer confidence numbers. And so as this returns towards trend, I think that tailwind behind US equity earnings is going to start to fade. I mean, if we look at US equity earnings, and here I've got the S&P 500, the earnings, the historic earnings, we call them the trailing earnings, are on the horizontal axis, and the price of the US equity market on the vertical axis. As you would expect, generally as earnings rise, the market rises. That is, what Warren Buffett was talking about when he kind of said over the long term, the equity market is a weighing machine. That these fundamentals are the gravity behind price over the long term. But we have concerns, M&G globally, in South Africa, that the forecast for those earnings just is like priced for perfection. You can see the yellow dot there in terms of the 12-month forward expectation for earnings. And it's, for another 15% increase, as if none of the things that I've highlighted so far matter to earnings. Now, if we look at the same story for the South African equity market, it's similar in the sense that the general trend is upwards, except for the fact that in the last 5 years, you've seen SA equity earnings continue to rise. Remember, that's on the horizontal axis. So as the green line's moving to the right, you've got earnings going up, but the market's been tracking sideways. And we're familiar with that story. That's all about the kind of negativity, the load shedding, concerns that South Africa's never going to grow, that we just can't get our act together from an infrastructure perspective, that our roads are full of potholes, and so it goes on. And my colleague René, in his presentation, which will follow, is going to drill down deeply into kind of what's going on in load shedding and how actually things may be improving there in time. But if we look at the 12-month forward earnings forecast for South Africa, there's just a huge gap between the current market price and those earnings. So even if you kind of say, well, I think those earnings are a bit ambitious, let's take 10% off them, the market's still sitting there, and we would say kind of 20% cheap to fair value, as well as offering, a reasonably compelling dividend yield. And one of the cheapest parts of the market is actually resources. So, I think it's appropriate that Aisha will be also drilling down into the resource markets and what's happening there. Nor is it just a question about earnings, because, I would also suggest that the rand is cheap. And many of you will be familiar with the Economist magazine's Big Mac Index. The Big Mac is a sort of reasonably homogeneous global commodity. You go to China and the Big Mac is the same as in France, although in France they call it Le Big Mac. But, it's the same burger and cheese. So I kind of thought, well, let's have a look at, maybe because I have a particular addiction to coffee, the price of a regular cappuccino around the world as an alternative to the Big Mac. And, it was interesting. I've got probably like 60 countries here. The US, I've indexed to 1 in terms of kind of saying, let's set that as a benchmark, about $5 for a regular cappuccino in the US. And that's the pink bar on the left-hand side that's highlighted. And the yellow bar is South Africa. So about 60% cheaper to buy your cappuccino at Vida than it is to go and buy your cappuccino in Chicago from Starbucks. So we'll start with that. But if we look at a broader based measure, perhaps one that, economists would say, okay, we need something that's kind of more kind of long term, we need a timeline. Let's have a look at the real effective exchange rate. South Africa, in real terms, so having adjusted for inflation against a broad basket of currencies, then, and I've put here against the 10-year average, we're about 10% cheap to that 10-year average. We're certainly not expensive. If you look at the 20-year average, that number's closer to 20% cheap. So, I would challenge anybody here to come up with a fundamental measure of rand valuation that shows the rand as being expensive. And yet, we see an ongoing offshoring of assets inside Reg 28 funds here, despite this fact, and despite that when we drill down into market valuations, so many of you will be familiar with the way in which we think about market valuations as a starting point, which is to look at the prospective real returns from current market prices, which are the bars, against our view of fair value, which are the circles. And South Africa are the darker pink markets on the left-hand side, and then some global peers on the right-hand side in the lighter pink. South African government bonds that Renee will be talking about, snapshot starting point, 6% prospective real return. It is priced for perfect awfulness. There could not be more pessimism embedded in that market price than there is now. If we look at South African equities, 9.5% prospective real return. Even if we kind of say there's over-optimism in the earnings, let's take 10% off that or 15% off that, you're still looking at a high single-digit prospective real return over the next 5 to 10 years coming out of SA equities. And yet, when you hear people talk about it, all they can say is, oh, but the US economy is never going to grow. Well, there's a lot of risk premium. That is why, the price is where it is relative to the earnings. In global markets, just very briefly, it's not that global assets are expensive. They're kind of fair to slightly cheap. But if we look at kind of global equities in aggregate, prospective return on our analysis, 6% real. It is modestly cheap, but nowhere near as significantly as South Africa or a number of other emerging markets. So pulling this together in terms of portfolio positioning, I've got a snapshot of our SA Balance Fund and some key metrics in the boxes on the right-hand side. What are some of the global equity markets we like? Well, I mentioned Brazil already. China. China has reopened from its COVID lockdown policy, its zero COVID policy, and the economy has already started to splutter. And we touch on that a little bit later in Aisha's presentation in particular. But there are Chinese banks trading on kind of half price to book, and lots of individual stock opportunities there in our view. We can see markets we're less keen on, the US, Switzerland's also a safe haven market, and Australia. If we look at bonds, we've kind of been overweight duration in South African markets, fairly neutral in global markets. Now, that is a big change, actually, in global markets. Some of you may have heard my colleague Jim Levis talk about that. He was very, very underweight duration in global bonds and has recently been neutralizing that, which reflects the fact that there are better opportunities there than there were. But in terms of credit assets, we're underweight both in South Africa and globally. A pretty sizable exposure to risk assets overall, total equity plus property at 70%. We would still say we've got bullets to fire there if markets cheapen and we do see some further cracks appearing in the global economy, and that causes a risk episode. we would like to be able to take advantage of that. And then I'd also obviously need to comment, and probably there may well be a question about it. We are running 32% offshore, which I think is less than many of our peers for the reasons I've highlighted. This is not a kind of, whilst offshore is an incredibly useful diversifying asset, this is not a great time to be pushing really hard on that, given the alternatives that are presenting themselves in South Africa. So with that, I will thank you for your attention. Remind you of the email address, f2f@mng.co.za. Please send those questions through to us. And introduce my colleague, René, who's going to be casting his net into the world of global and SA bonds. Thank you.
you.